Good afternoon. Thank you all for being here. What we'd like to talk over the next hour is to talk about the prospects for emerging markets. We have a distinguished panel with people from different region experience, different types of asset classes. And the way we'd like to handle it is to have initial comments of no more than about 3 minutes each, where people talk about the topics that they are most interested in, where their focus is going to be, and what they think are important issues for the emerging markets. By doing that, we are hoping to have the final 45 minutes, most of the hour, available to you for Q&A. During that session, there are, I believe, 3 or 4 microphones roving around the floor, and please wait for them to come close to you to ask questions. And I hope you have lots and lots of questions, otherwise we are going to finish ahead of time. The big issue that we start out with is as to whether the emerging markets are a real asset class after all, or is it just a product of the quantitative easing that was taking place under the aegis of the Federal Reserve. And if that is a real asset class, what is going to happen when the world liquidity tightens? And hopefully you will have questions as well in terms of what regions would be of interest and how to go about approaching it. We'd like to look at different asset classes. And for those of you who are investors, how best you can take advantage of it. In terms of the people whom we are going to begin to my far left, Jay Pawlowski, who is the principal of J to Z Advisory, and formerly the chief emerging market strategy at Morgan Stanley. And he's going to start it off with an overall view on emerging markets, as well as some findings from a trip to China where he was recently. Then after that, we go to the person immediately to my right, Madeleine Antonich, who is the Vice President and Treasurer of the World Bank, and her focus is going to be more in terms of what emerging markets means as an asset class, whether it will survive the changes in monetary policy in developed countries, and what is very important to all of us, given the role that it plays, what the World Bank can do in terms of fostering the asset class is an important area to be in. After Madeleine, to my far right, Ricardo Adrogué, who is the head and the managing director and head of the emerging market debt group at Babson Capital. And hopefully you'd have questions for Ricardo regarding what happens when US interest rates start to move up. Does it still make sense for you to invest in emerging market debt? And if so, how can you still continue to benefit from it? We are going to finish with Jim McCucken, immediately to my left. And he's the CEO of Principal Global Investors. Some of you probably saw the great panel that he moderated on the global economy yesterday. And one question I would have for him is, where do emerging markets fit, Jim, in your overall global portfolio? But Jim is going to begin with his particular focus on China and where he sees the opportunities. I'm going to be more of a traffic policeman. I'm going to make sure that your questions get answered. And we'd like to spend more time in terms of talking to you, answering your questions, than enjoying our own spiel this afternoon. So with this, Jay, let me have you start it off for us.
Great, thanks, Sri. And when I think about emerging markets, I try to put them in a global context. And so when I look at the world, I see a world that has broken growth models across all the main regions of the world, the United States, Europe, and the emerging economies in particular, with the export and investment-led growth strategies of the past 15 years no longer viable. And we've buffered this period of broken growth models via 2 main sources of global liquidity. The first being the Fed with quantitative easing, and the second being China with its giant credit expansion of the last 5 years. And when I look at things today, it strikes me that there's a very high bar for the Fed to reverse its tapering policy. And my trip to China was to try and ascertain what is the likelihood of another major stimulus out of China. And I come back thinking it is extremely unlikely for the following 4 reasons. First, the 2009 stimulus package in China is widely seen within the country as a major strategic mistake. 2009 was the opportunity for China to reform and rebalance with someone to blame if things got wrong, with a scapegoat. and that scapegoat was obviously the United States. Now, if anything goes wrong with the current reform or rebalancing, there's no one to blame but the current leadership itself, and that alone gives you insight into the speed and degree of magnitude of the reform process in China. Secondly, the 2009 stimulus resulted in a massive misallocation of capital. And that massive misallocation of capital will continue to be felt for years to come because many of the projects approved during that period are coming on stream today, though demand is much lower than what was forecast when those projects were approved. So this is a problem that is going to be with China for years and years to come. Third, the 2009 stimulus led to the explosion of two fundamental issues confronting China today. The first, pollution, and the second, corruption. I came away from my visit thinking that the West should not be viewing the danger in China as being property or debt-related. The tail risks in China are centered front and center on environmental and corruption concerns, in my opinion. And fourth and finally, even if the current leadership in China wanted to do a major stimulus, they'd simply be repeating what the prior leadership did. And as we all know, politicians everywhere don't like to do what has already been done before. So I came away thinking if there is a major stimulus package coming out of China, which again I see as highly unlikely, that will be a sign to duck and cover, not to invest. So when I think of emerging markets broadly, to me, it is probably the toughest road to hoe in terms of fixing and moving to a new growth model. Confronted with stagflation, limited potential for exports, and the more recent upheaval in currencies has led to a sharply higher interest rate profile across many of the emerging economies, which I think is going to lead to another shoe to drop as the domestic credit and consumption story gets pushed back because of those higher interest rates. So all told, Sri, I don't want to take up any more time, but all told, I'm quite cautious on the asset class.
Great. Thank you for that. And again, thank you for staying within the time, Jay. And I know that you'll have lots of opportunities to take more questions as we go along. Madeline, if you would, again, start us off on the EM as an asset class, and again, what the World Bank's role could be, and especially some of the lower income countries, what you see the prospects for those emerging markets.
Okay, thank you very much. Well, I'm going to address whether EM, the success story has staying power, and I have to say that I don't exactly share the views that it's sort of not necessarily a sustainable asset class, so I guess it's a little bit of the opposite side of what we've just heard. Let me tell you why I think that it has staying power. Firstly, I think you need to say that you need to look at and differentiate EM. EM, for sure, without a doubt, is not homogeneous. You need to look at it and differentiate with respect to fiscal prudence and with respect to governance and transparency. So I want to talk about a few of those things. But before I do, I just want to turn to one chart, chart number 21.
Chart number 21.
Please. Which I consider a fun diagram. So to me, a picture tells 1,000 words when you look at EM, and this is just an example, just looking at Africa. Here you can see Africa is such an enormous country. It can house China, Mexico, East Europe, West Europe, the Arabian Peninsula, India, Japan, United States, China, I think I said, all in one. So it's an enormous country. And it's interesting, people talk about Africa as if it's one country. It's 54 different countries. Africa's population is 1.1 billion people. China is 1.3, India is 1.2. Their GDP, if you aggregate it across all of the African countries, GDP is $1.9 trillion. Italy is $2 trillion, and France is $2.6 trillion. And if you think about the people that are in Africa, 600,000 people have cell phones. So in my mind, this is an asset class that's here to stay. Of course, there'll be bumps in the road, but I think it's clear to me, at least, that it has staying power. So let me get back to my point about differentiating. You need to differentiate with respect to, as I said, fiscal prudence and with respect to governance and transparency, because clearly they're not all the same. So if you look at, on the fiscal side, over the last 10 years or so, countries have done enormous things in terms of having big improvements in terms of their fiscal balances. So that goes on both the asset and liability side of a country's balance sheet. So if you look at debt management, they've changed the debt management policies dramatically. They dramatically transformed the debt portfolios. And basically they've done 4 things. They've reduced the foreign exchange exposure. In the early 2000s, external debt to domestic debt was significantly higher than it is now. ECA has reduced, the ECA region has reduced their external debt relative to domestic debt from 2.6 times to 0.5 times. So they've dramatically improved their exposure to external, which obviously is what causes these shocks when they're, so they've insulated themselves dramatically from shocks. They've extended the maturities, also on average, but if you look at the LAC region, Latin America, they've tripled their average life, so from a little bit less than 1.5 average life to over 4 years. They've reduced their dependency on floating rate debt. Prior to their fixing up their balance sheets, the floating to fixed rate debt ratio was 1.3%, meaning they had 130% more floating debt than fixed debt. But now, since 2008, they have 8 times as much fixed debt as floating debt. So they've really gotten their fiscal house in order. And of course, they diversified their funding, source of funding, largely to the internal markets, not necessarily externally. If you look at reserves, can we have chart 27, please? So we all know that on the monetary side, reserves have increased substantially. But here you can see that reserves in the emerging economies have increased 5.5 times over the last just 10 years. And on the developed economy side, you can see that it's only increased 4.4 times. Can we also go to chart 28, please? And importantly, you can see that the reserves, if you look at the import coverage, has gone from only 6 months coverage in 2000 to close to 13 times import coverage more laterally. Now, clearly, import coverage is not the only way you want to look at reserves. Another reason you want to look at reserves is short-term liquidity. But again, given that I told you about the kinds of balances that they have on their debt portfolios, it's also an improved situation. So the point that I want to make here is that central banks now have so much reserves beyond the optimal level that they've now put them into sovereign wealth funds, their own sovereign wealth funds, which are still part of the reserves but don't show up on the IMF reserve numbers because IMF reserve definition is for balance of payment. And so sovereign wealth funds are being used for stabilization, i.e. fiscal buffers. It's being used for savings, so long-term infrastructure.
And let's stop there and see, we'll come back to you on that, but go on to Ricardo regarding what is happening on the debt side, and Madeline talked about the improvement in some of the ratios. In a period where you had a tailwind, Ricardo, over the last 5 years on the emerging market debt side, and you were able to do well, are you facing a new situation? How do you manage the debt portfolio, and how can you do well for your investors under the new setup?
Thank you. If we can show slide 19. I'm going to Madeline's point about being a true asset class. And here I'm focusing on purely fixed income, emerging market fixed income asset class. What we show here is the major asset classes. In green, we show the emerging market asset class. The pie on the right shows that emerging market debt, fixed income, represents now 25% of the overall fixed income asset classes. And it has been, if you look at the chart on the left, the fastest growing asset class in recent times, since 2007. And that brings us to, well, number one, it is an asset class that is difficult to avoid. If you are a global fixed income manager, or if you want to have global fixed income exposure, you need to have some emerging market. At the same time, it's a pie that has grown among the fastest in the world. And that tailwind that gave rise to that impressive increase in the stock of debt, emerging market debt, now is unlikely to carry forward in the same way that it has been in the past. As Madeline suggested, the fiscal situation of most of the emerging market countries are better. Their debt has improved, the structure of their debt have improved. And from a macro perspective, a lot of these countries now have flexible exchange rates. And what that is a shock absorber to foreign shocks. However, there is elements that emerging markets have built up that are similar to risks that have affected emerging markets and developed markets in the past. Specifically, credit has grown quite dramatically, and this is not just in China. And that growth being higher in emerging market was to some extent at the expense of larger current account deficits. So if we exclude China and we look at emerging markets now, it is more common to see emerging market current account deficits again that need obviously international financing. So as the Fed normalizes policy, emerging markets will have to face an adjustment, either because there's not enough financing or because they need to adjust their current accounts through better policies and higher productivity. And that leads me to the conclusion that emerging markets not having a tailwind that they had in the past, going forward, especially on the fixed income side, we need to be quite selective. We need to make sure that we are in the right places, the places that Madeline mentioned about having good fiscal policies. Unfortunately, there's very, very few, if any, countries where the credit policies have not been loose within emerging markets. But the fact that they have been loose doesn't mean that they will end up in a crisis. We need to see how those have taken place, has it been for investment, and how those can be unwound.
Thank you, Ricardo. And hopefully, during the Q&A session, you'll have the opportunity to say how you'll go about choosing those right countries and to be very selective in terms of your countries. I think that will be helpful to the audience. Jim, in terms of where, as I said before, I'd like to ask you, where do emerging markets fit in your thinking, your firm's thinking on how it fits in the overall global portfolio? And again, given your interest in China, to talk somewhat particularly about it, and you provided a slide in terms of the winners and losers from the renminbi, the yuan movement, and the Chinese currency changes. And if you can talk about that as well, that'll be great.
That'd be great. Thank you, Sri. First, very simple point I'd make on what Ricardo was saying is emerging market fixed income is here to stay because the bond markets are needed, given that the global banks can't provide the credit in the emerging markets anymore like they used to. So a large part of the development of emerging credit is the weakness of the banks and the changed role of the global banks under pressure from the regulators. So I'm with Ricardo that this is an area that has a long-term future in portfolios, and the fact that there are motivated issuers will tend at times, not all the time, to give you attractive opportunities in emerging debt. The other point I'd make about the role in portfolios is that I still do believe that over a 5 or 10 year view, the growth in developing, emerging, frontier markets will be greater than that in developed markets, and that therefore the opportunities for equity investors will be quite dramatic. So I do believe that long-term point. However, I'm rather short-term with Jay in being a little cautious. I can see a lot of clouds on the horizon. Maybe on the equities, in order to put this in perspective, I can refer to the chart on China that Sri mentioned, which is slide 30. So that's slide 30. Yeah. People always talk about the 20 years, the unprecedented 20 years of growth in China, which started about 94, as being a result of urbanization with the associated productivity growth, infrastructure development, which enables business, and then, of course, economic liberalization. There may not have been political liberalization in China, but there was plenty of economic competition, and that's tended to reinvigorate some of the formerly moribund state-owned industries. So that's all helped the growth. But really, this chart shows something which I think is really not that often talked about, but is actually very important in the long term. And that is the impact of that 57% devaluation between 1990 and 94 in the renminbi. And that was something that happened just as China was liberalizing, and which led to a period of extreme competitiveness when China was able to build mercantilist policies and export-led growth. It was really Japan's playbook from the 70s and 80s repeated. And rather as Japan's in the late 80s did, I think it's played out. I don't think there is much prospect that the driver of growth in China can continue to be so purely exports. And I think the Chinese recognize that, which is the reason for the massive credit expansion that we've seen in China in the last 4 or 5 years, particularly since the 2009 stimulus initiative. And I do think that that expansion of credit is really very dangerous. If we can look at slide 8, it shows different countries in the world by debt to GDP, government debt to GDP. China has a very benign 23% number. My belief is that's almost completely bogus because it doesn't include local government debt, state-owned company debt. And if you included that, there is a lot more debt in China, particularly when you look at the consumer and look at the real estate debt. So I think you can look at charts like this and get the wrong impression. I do think that the nature of growth in China needs to change looking forward. It needs to become domestic, it needs to be consumption-driven. And I do think that will be a tough transition. My guess is that growth will be lower for the next couple of years than most pundits and indeed the Chinese government think. The Chinese government have nailed their colors to a 7% growth rate. In reality, I don't think they're going to get it, even though they might claim it. So I do think in China and in several other emerging markets, growth in the next 2 years will disappoint because of some of the imbalances that we've been talking about, and therefore expect a rough ride, even if the long term is quite benign.
Jim, thank you very much. Jay, let me start the questions off with you. And again, we would urge you to think about questions. And I see at least one microphone here. If you put up your hand, somebody will bring the microphone to you. But as you're thinking about questions, I'm going to start it off with you, Jay. I know you've followed Japan for quite a while, and you have thought about, written about the developments there. And every day, every evening before we go to bed in Los Angeles, I look at what happened to the yen the following morning in Tokyo. Is this an opportunity for Asian emerging markets or a risk as to what's going on in Japan? Is it helping or hurting in terms of all the focus on Japan? And what does it do to a country which is a close competitor, like Korea, for instance? What does it do to Philippines or Indonesia there?
Well, I think that's a fascinating question, Sri. I've actually been looking at it more from the side of, Japan has been penalized by the emerging market crisis because the yen is seen as a safe haven. And the case that foreign investors in particular liked about Japan was weak yen, rising profits, and I'll buy the market. With the crisis in emerging markets, money went into the yen strengthened, foreign investors left, and the Japanese equities came off, and they're the worst performing of the major markets. So I think really the opportunity from that perspective is more in Japan, but in Asia, in the Asian emerging markets, another thing that struck me from this trip in China was just how powerful the Chinese economic engine is vis-a-vis its neighbors. And I think this is something that we in this country don't fully appreciate, and certainly our politicians don't appreciate when you think about the TPP, the Trans-Pacific Partnership, and the idea that we can actually develop a regional economy that doesn't really include China. It may make sense from within the Beltway, but it is absolutely ludicrous when you're sitting in Beijing or Shanghai. That makes absolutely no sense. So to me, one of the opportunities that came about as I see China and what's happening there is the outflows of capital. I think that the big move in the next couple years in EM, all we've been talking about is how US-based and European-based investors have sold emerging markets, have gotten out of emerging markets. The big move in the next couple years is emerging market domestic capital diversifying abroad. This is one of the reasons why EM has been so strong relative to the news flow in the last 6 to 9 months, is because the domestic asset base has really grown and it's become a very viable investment base itself, and that is supporting EM. Going forward, I think those portfolios are going to diversify, and so one suggestion I would have is to try and understand where that money is going to go. because it's always follow the money. And the money that's going to be moving in the next 5 to 10 years is EM, domestic money, globalizing.
Thank you, Jay. Madeline, from your perspective in Washington, D.C. and the World Bank, Africa is now the newest frontier that people speak about. And for decades, it has been seen as a low-income region. It has been close to foreign capital. Things are changing. What's your view on that? And in terms of infrastructure, climate change, various areas that the World Bank is associated with, how do you see Africa and the progress there and the potential for foreign investors?
Okay, thank you for asking that question. But can I just respond to the China first?
Sure, please do.
I agree that the road could be a little bit bumpy, and in fact, short term could be bumpier than longer term. But I think the government really has, or at least from my perspective, really embraced reforms, both on the fiscal side and on the monetary side. On the monetary side, of course, opening up the capital accounts, I think it's a huge thing. The Shanghai Free Trade Zone that they announced in September is an enormous, at least, recognition that they need to open up their capital accounts. They're allowing interbank borrowing and trading. The World Bank was the first MDB or IFI that was given permission 2 years ago now, and we have currency lines with them, and we trade in RMB. The backup in the RMB allowing that to happen, I think, is a very significant message to say that it's not just a one-way ride. And of course, widening the bands and so on. On the fiscal side, I definitely think they have reforms going. And I agree very much with Jim's, urbanization story, but the reality is that they continue to push for that. And most recently, they've announced that they're going to increase urbanization by 2020 to 60%, up from 54 today. And of course, try to abolish this the city residence rule. Now, of course, in order to do that, they need to put certain reforms in place. They also are looking to go from investment to consumption. They can't go to consumption growth until they put the social safety nets in place, which they are working on. And we do a lot of work with China, as you can imagine. So I think I'm a little bit more positive on the China story. Clearly, in all of these countries, it's a couple of steps forward, a couple of steps back. But I think that they recognize the importance of sort of joining the whole world in terms of making progress. And again, when consumers have cell phones, they have the internet, and they can see how the rest of the world lives, they really do have a voice about pushing forward. In terms of Africa, we can go to chart, I don't know what number it is. Oh, sorry, I don't know the number. So I do.
21.
No, that's not the same one.
That wasn't
Jim, do you have your charts?
Do you know where it falls?
Yeah, right after the Africa picture.
Yeah, 22.
22, thank you,
22.
Jim. Thank you.
You're welcome.
I wasn't going to use this, but now that you've asked. It's interesting that people think about Africa, again, about, sort of small countries, obviously not highly developed, low GDP, but here I just thought I would show a few African countries that have their GDP for 2012 compared to the peripheral countries. And everybody focuses on the peripheral countries, but you can see that some of the countries in Africa are either higher or equal to. So in terms of size, again, as I said, $9 trillion in aggregate, but even you can see some of the smaller, sort of the individual countries are not small. And in fact, just, I guess, 2 weeks ago, Nigeria have stated that their income is a lot even higher than that because they have now unearthed some kind of change in the tax policies and their way they're accounting for the numbers. But anyway, the income is not staggeringly high, but it's not small either compared to peripheral, European countries. I think in Africa, there's clearly opportunities, but there's clearly a lot of things to watch out for. I think one has to really think about what growth is sustainable growth. You can take a look at some countries that have, very high growth, but they're coming off a very low base, and it may not be sustainable. They may have come out of a civil war, like Cote d'Ivoire, or they may finally have, access to multilateral or bilateral investing in FDI. Myanmar is an example. On the other hand, some countries Uganda have spent the last 20 years putting into place enormous reforms. And so they're, well positioned. Other countries, Tanzania, is a robust economy. On the other hand, they do have constraints with respect to infrastructure and shortage of skilled labors. So you really have to look country by country, and just, so it's about governance, it's about transparency, it's about skilled labors. In Nigeria, frankly, the youth population is growing so rapidly that they don't have enough jobs to be able to absorb all that. So it's about, the jobs, it's about skilled labor. If you can go to the doing business page, slide 23, please. One way of looking at and helping to discern all of what's going on is you can look at something that the World Bank puts out, which is the doing business rankings. And this is a rankings of all the components of putting together, organizing business, so starting a business, getting electricity, getting the permits, enforcing the contracts, insolvency, how do you protect consumers, and so on. And this is something that's really quite powerful, frankly. Lots of countries don't like this because, obviously, if they're not ranked well, they find all kinds of criticisms. But at the end of the day, it's a very powerful tool because a lot of countries compete, and so this encourages them to move up on that index. And in fact, over the last couple of years, 9 out of the 20 best improvers on the doing business index has come from the African countries. So there's a lot to be done. Clearly, infrastructure is a big investment opportunity. And by the way, agriculture is huge, transports, electricity, obviously, but also logistics, because then once they have the infrastructure, getting things from point A to point B is a challenge. So clearly, you have to differentiate, you have to do your homework, but there's plenty of, I think, potential opportunities. But again, the transparency and the governance is a very, very big consideration.
Thank you, Madeline. Any questions from the floor? Sir, the gentleman in the middle.
Yes, thank you. This is for Ricardo. When you think about the various segments of emerging market debt, for a US-based investor, you've got investment-grade corporate, you've got sovereign, you've got high yield, you have dollar-denominated local currency. Where do you think the best opportunities are at present within those sectors?
Sure. So the best opportunities that we see are on the hard currency side. Mostly it's on the positive view on the US dollar. If you think about it, the US has been able to get its energy complex going, has improved its competitiveness quite dramatically. The current account deficit now is 2% of GDP. The fiscal deficit has come back to 3%. The economy looks ready to take off. And that, with the credit that basically has shrunk. So it has a lot going for it. So from a US investor, I would personally think that a hard currency US dollar asset is more attractive today.
Ricardo, would your view be different if you were given 5 or 7 years and you're looking at rapidly growing emerging markets with appreciating currencies with respect to the US dollar?
Yes. In that case, it would be more the local currency that, which is my favorite, my personal favorite. But going back to the original, my interpretation of your original question is over the next 2 years, 3 years, I think a hard currency, both corporates and sovereigns look attractive. Now, in both cases, you need to be selective. Yes. You have in the hard currency sovereigns, the spread over US Treasury is only about 300 basis points, and that includes countries that pay 700-800 basis points over US Treasuries, like Venezuela, Ukraine, or Ghana. And then you have countries that offer 150, so the investment grade credits. However, there are good stories. Ivory Coast is one of them, where you can trust that they're on the right path and they're still offering a great premium. The other recent emerging market addition, Greece, is another country where they have done a tremendous adjustment, and they are now part of European Union that is significantly stronger. So, and on the corporate side, the way we tend to look at it is we take the overview of the sovereign side, the sovereign credit, because a lot of corporate defaults have been caused by sovereign defaults or sovereign problems. And we take a very in-depth bottom-up approach. And so we distinguish out of the close to 500 issuers, 499 issuers that are in the S&P broad, we take a look at about 400 of them, and we take a very in-depth view on each one, and from there we select which corporates are attractive. Now, on a longer-term view, I think the local debt does offer value. The issue here is the way we approach the local debt is by thinking that these countries eventually will have their own monetary policies, and those monetary policies will be credible. That has been highly questioned since the tapering talk began. Everything sold off in line with the Fed. And so you need that to build up. You need countries to start to show that they have credibility, and so their local yield curves to start to reflect. On pure yield basis, they're significantly higher. They offer almost 7% in a 4.5-year duration, so you won't find that yield anywhere. It does come with the currency component. The currency has adjusted about, call it 7%. It is dependent on a recovery in the developed world and trade recovery for the currencies to start doing better, in my view.
Thank you, Ricardo. Jim, would you like to take that question too?
Can I give some very brief comments on particular aspects of what Ricardo said? Firstly, if you look at emerging market debt on a global basis, you find places that are attractive, and I would agree with Ricardo about dollar-denominated emerging debt, that's a particularly attractive area. But you also find pieces of the market around the world that are spectacularly unattractive. And what that has said to some of our people in the emerging market debt areas, the best way to look at emerging debt is on a long-short basis. So don't try the long only, because you're liable to be exposed to some real duds if you just go long only across the market. It's a selectivity point. Second comment I'd make on what Ricardo said and on the question is we've got used to a period when high inflation, high interest rate currencies were in demand because of carry trades. I believe we're going to see a change in the financial environment, which will mean that high inflation countries will have structurally weak currencies rather than structurally strong ones. So I do think you need to watch inflation and balance of payments, which are really key issues that will drive the currency. I think those are really two areas. Then, if I take my third point, which is, I can't resist taking up Ricardo's last point about money supply and monetary base. When the taper talk started last year, it became very clear that the emerging countries had been piggybacking on the Fed and importing their monetary base expansion. What I mean by that is they had not had to attend to the monetary base for the banking system in any way, and they'd been relying on the Fed, which is why it became such an emerging market crisis when the tapering was announced, let alone happening. I think looking forward, there's a bit of a call to action there, which is emerging market central banks, you better straighten out your monetary policy.
Jim, that's a very good point. And again, for those of you, just to recall what happened in May, June of last year, when the Brazilian finance minister used to be criticizing the Fed for currency wars.
Yep.
And then came the Bernanke speech on May 22nd. By June, Brazil had cut all the taxes, was trying desperately hard to get the speculative capital to come back in again. So it was quite a switch.
Yep.
Changing topics a little bit, and as we wait for any more questions from the floor.
Yeah, we got one.
Do we have one? Oh, sir, the gentleman in front.
Your comments were a very good segue. I was going to ask the panel to share their comments both on the Latin American region and Brazil in particular, given the headwinds we're seeing there, and also on Eastern Europe, given the geopolitical issues that we're experiencing there.
Who'd like to take that on first? Go ahead, Jay.
Yeah, I'll maybe just say a little bit about Mexico, which I think has been is a great economy, has done really, really well from a macroeconomic stability point of view, but yet hasn't been rewarded for it really at all. And in fact, has been a pretty big disappointment for those of us, such as myself, who have been investors and recommenders of the country. So when I look at Latin America, Mexico stands out to me on a number of fronts. It has the best macroeconomic backdrop, as I mentioned. It's close to the United States. It's going to be a big beneficiary of reshoring, of manufacturing activity coming back onto the American or North American area. One of the things that I learned in China was that the Pearl River Delta, which of course is where most of the manufacturing has been done in China for the last decade, is finding it very tough to make money. It was amazing to me the number of times I heard in an economy that's supposedly growing 7%, how hard it is to make money.
Yep.
And so...
suggests it's not growing at 7%.
Yes, exactly. But so Mexico to me is very interesting. Brazil, on the other hand, I think really squandered an opportunity in the last 5 to 7 years to take advantage of the demand for commodities and restructure and reposition itself. They have significant human capital limitations, which I think are going to be manifested here in the next couple of years as they try to build their infrastructure for the World Cup and the Olympics. Brazil, interestingly enough, when you talk about countries that may see outflows of capital from domestic investors, Brazil is the 4th largest institutional asset base in the world. 4th largest, over $1 trillion of institutional invested money. Less than 2% is invested offshore. Now, part of the reason for that, of course, is that you get 7% on 30-day paper, but I would look for Brazil to be a difficult place for a foreign investor to make money over the next couple of years. And again, the idea that I'd be interested in is understanding where the Brazilian institutions are likely to put their money as they start to globalize.
Jim, did you have something to add?
I do. I think that, outside of Mexico, whose great good fortune is to be right next to the United States when the United States is doing well, in the rest of South America, I think the key issue here is that they've had a tailwind from commodities. They will now have a headwind. Commodities in oversupply. As Jay said, that the Brazilians had blown the opportunity. I'm not sure it's that bad, but I think they will have a bit of a headwind looking forward structurally. Having said that, the factors that really led to China growth, infrastructure development, urbanization, economic liberalization, those are at an earlier stage in South America than they are in China. I think there's a decent chance that those factors will actually produce decent growth in Latin America, albeit with structural inflation, which is why I'm not keen on their currencies longer term. But I think it'll be a decent place to invest. But lastly, I do think very key here in thinking about Latin America, both Mexico and South America, is that the local investor is going to be really, really important going forward. Jay mentioned the size of the Brazilian institutional assets. We know from our own experience that pension assets in Mexico and Brazil and Chile continue rapidly to grow. Even the title of this session talks about the inflows into emerging markets. Looking forward, that's no longer as key because the emerging markets themselves have a wealth that will create greater depth to capital markets. So I think we're seeing a kind of an intermediate stage, and those are among the reasons why I continue to be long-term a bit of an enthusiast for emerging markets.
Thank you, Jim. Madeline?
Yeah, I would agree with Jay's points, both with respect to Mexico and Brazil. I think Brazil, one of the problems it's suffering is from the so-called middle-income trap. Sometimes countries are able to grow rapidly, and then they sort of hit that plateau. And I think it's fair to say that Brazil might be there. They've got huge infrastructure needs as well. They've got low business confidence right now, so weak private investor growth. And because of their fiscal and monetary policies, monetary, of course, rather tight right now, fiscal buffers really aren't there, and so they have this problem where they have the middle class is really getting rather frustrated because they're asking for more services, but of course the buffers aren't there. So I share that point. One thing I'd like to mention about Mexico, which really is something that we're working on more broadly, and a very important thing, I think, for countries' balance sheets, and that is Mexico has been very, very progressive in terms of its all of its management of its balances, including, very importantly, its contingent liabilities. So, and this is disaster risk management, and I think this is a huge area of growth. $3.5 trillion we've seen over the last 30 years of damage due to earthquakes and hurricanes and so on. And Mexico has really been one of the first, and they work very closely with the World Bank, and we've recently done another multi-peril, multi-regional cat bond with them. And they set up a fund back in '96 when they had a very large earthquake. And then by the mid-2000s, 2007, they started issuing, with the World Bank, issuing a disaster risk management. And UTE, let me just tell you about this. In Uruguay, also it's kind of catching on right now. By word of mouth, Uruguay came to us 2 years ago. They had a $500 million shortfall in their budget because they had a drought, and UTE, which is their electricity provider, it's their utility, has 85% of their electricity comes from hydropower. And so they came to us and we worked, and we just closed about a couple months ago, largest ever weather and energy derivative, where they're getting a $450 million payout over 18 months. So a lot of the Latin American countries, we do a lot, within Treasury, I do a lot of risk management solutions, whether it's debt, interest rate, foreign exchange, or disaster risk. And I have to say that the Latin Americans, Mexico, UTE, the Colombians are doing huge things right now on earthquake insurance and earthquake derivatives. They've calculated a 1 in 250-year earthquake, which is something that's probable for them. It's 8% of GDP. So they really understand the importance of it. And so Mexico, I think, was one of the leaders.
Thank you, Madeline. Ricardo, what countries do you like or not like in the whole part? And perhaps since you're on the fixed income side, where would you take a fixed income risk at this stage? Where on the emerging market debt, which countries would you like the corporate debt as opposed to the sovereign?
Yeah. So a lot was said about Latin America, to which I agree. That is a good segue to countries where we like the corporate sector, given what they are offering in terms of return. Those include Mexico, Colombia, Brazil. Countries that we think are heading the wrong direction, even when they still offer great returns in Latin America. But in some cases, we avoid them, Argentina and Venezuela. As I mentioned, they offered 700 to 900 basis points over US Treasury. Still, they're heading the wrong direction, so doesn't seem to be the right places to invest. Now, your question was also related to Eastern Europe and the situation that is evolving there. Our base case, or my base case scenario, is that it will be a long, protracted period of sanctions and isolation of Russia. And that today is the good scenario. Now, Russia was already, from the perspective, the macro perspective that we look at, a macroeconomic deteriorating story in the fact that with very high oil prices, they were increasing fiscal strains, very slow, but very steady. And they basically don't have a fiscal deficit, but they were growing towards having a fiscal deficit. And more importantly, the current account deficit, or the current account surplus, was shrinking very dramatically before all of this happened. Now that all of this is happening, and assuming a long-term scenario of isolation, gradual isolation of Russia, that would be a very good environment for emerging Europe. So, and from the credit perspective, those are the best places. So Hungary offering 300 plus basis points over treasuries, or Croatia offering close to 400 or 350 basis points, or Greece. Those are very good credits. They have done the adjustment. They have much smaller fiscal deficit. Croatia may not be there yet, but they have done quite a bit of adjustment. They still have large fiscal debts or government debts, but those are in the process of getting repaid. Their credit have shrunk to size. So those are very, very good places to invest from the hard currency side.
Thank you, Ricardo. There's a gentleman in the third row.
Thank you so much. This is to Madeline. I know you mentioned that governance and transparency, are very, very key. I think that one of the major issues or challenges that can actually derail the gains that are being made by the emerging markets is the income distribution. You have the widening gap, in income distribution. I don't know whether the World Bank has a view on this, and what do you suggest that needs to be done in order to address or close the gap? Thank you.
Thank you. Good questions.
So was the question about, does the World Bank have a view on income, the gap in the distribution?
Yes. What is the World Bank's view on the income distribution, the gap that we have in the emerging markets, and what do you suggest is a way to address it?
Okay. Well, I can just tell you that the view is that we have twin goals at the World Bank. One is to eradicate poverty, and the other one is to boost shared prosperity, because clearly you can take a look at some of the incomes in some of the countries, and then you can take a look at the Gini coefficients, and they're not looking so great. You can see how there's this huge disparity between, you know, the very wealthy and the very poor. And so the view is that that's one of the major goals of the World Bank, is to boost the shared prosperity. In terms of transparency and governance and all of that, I think one of the important things that people may not be aware of is that a large part of what the World Bank does, we don't just make loans and give out money. What we do is the loans that we make are all conditioned upon certain criteria being met, not so much on fiscal balances, because that's really what the IMF worries about, balance of payments, and what we worry about is development. But we make loans, most of the loans that we make are either development policy loans or investment loans, and the investment loans are the biggest ones. And so these are where we build, you know, bridges or transportations or you know, dams or whatever. And the important thing is that it's about the procurement and the policies and the procedures to help about the governance, to teach countries really best practices and best governance. And many countries, by the way, that borrow from us don't need our money, because you take a look at the biggest countries, and they don't need to borrow from us from the money, but they do like to borrow from us, so that along with the money comes the package of us being involved step by step all the way in terms of implementing these projects. And so it's to oversee and to make sure that there's safeguards in place, whether it's, you know, environmental, social standards, all about the governance, and it's also to be able to share knowledge in terms of how things are best practices that people within the country know how to execute projects in the future. So it's a huge priority of the banks.
Thank you, Madeline. I'm going to extend the gentleman's question a little bit further myself and say, as you talk about economic growth and the pie is getting larger, is it inevitable that the income distribution is going to worsen? I think that may have been, sir, part of your issue. Does the income distribution have to get worse as you get better? And Jay, Jim, I was going to go ahead. Get started, Jay.
Yeah, no, I definitely have a view on this, and that is that this is a problem that's not just obviously in the emerging markets, very much in the developed economies as well, and it's in large part, I believe, driven because the returns on capital have been so far superior to the returns on labor, and this is in part due, I think, to the expansion of the labor pool globally. And I think the issue is, do you expect the returns on capital to be as high relative to the returns on labor in the next 10 years as in the past 10 years? I personally don't. And I think, therefore, this issue is kind of top of mind and topical today, but is going to be less of an issue going forward, because I think we're going to realize as economies and societies that the top 1% can't possibly consume enough to make the rest of us all whole and living a good, productive life where we can make money. And so I think the imbalance, which if you look at the data in the U.S., at 50-year lows in terms of the share of income to labor versus the share of income to capital, that's not sustainable.
Thank you, Jim.
I've never found the Gini coefficient very helpful in thinking about this. To me, the key issue here is whether you end up with an economy that's full of people that have the means to consume or don't they, and to get out of poverty and get the middle-class lifestyle, which is how economics develops. So if I look at some of the world economies, Brazil is making big steps in that direction very positively. Argentina and Venezuela are not. You're not going to see the same development in those countries that you see long-term in a Brazil because of the growing middle class. And I think it's really that, rather than the pure Gini coefficient, that's the issue. And if the mass of the population is coming out of poverty and is able to graduate through, they buy a bicycle, then a car, then a home. If they're in that sort of developmental progression, which the Chinese, to a large extent, have been, the urban Chinese, I think that's the recipe for a growing and vibrant economy. Whereas someone like the Ukraine or Venezuela, where there's an oligopoly of of an elite, that is just not going to lead to prosperity and actually leads to economic basket cases.
Thank you, Jim. We have time for one quick question and one quick answer if anybody has from the floor. There's somebody there? Oh, okay. Then let me.
Can I take one more? Yeah, okay. It actually relates to China this time around because the graph that you showed, the debt to GDP is about 23%. And you mentioned that there are so many things that are not disclosed in that particular place. And the ratio actually can be higher than 23%. And given the growth of China is being in excess of 7% for some time going, my question is that growth sustainable? And secondly, because there are certain things that are not disclosed in the debt to GDP ratio, are we likely to see a bubble in China? Thank you.
And perhaps you may also want to add to that, if you have a public debt to GDP ratio which is high, but you have also the private sector which has savings, as the Chinese do, does it reduce the burden of the overall setup?
Yeah. As regards the idea that there might be a bubble in China, I think the questioner is right to worry about that. My take at the moment is that although the expansion of credit in China has been extremely rapid, as both Jay and I said earlier, in the last 4 or 5 years, it's happened keeping the economy going. It's happened in an economy where the banks can actually be state-owned. They're all state-owned. They can keep the system going by provision of liquidity from the central bank and the government. And so when you ask the question, is there a bubble in China, the next question is kind of, when's the financial crisis in China? Well, I think there's probably all the ingredients economically to create a financial crisis in China. Will it be this year or in 10 years' time? Very hard to tell, but my bet is it's a long way out rather than a short one, just because the government has also got a lot of resources to keep the economy going.
Yeah, if I could just add, we had over 25 meetings in China in the course of a week, and it was with 2 other people. We spent all our meetings trying to find the catalyst for a big crash in China. It's really hard to find the catalyst. I mean, you can lay out the debt problem from soup to nuts, property, et cetera. All of that's very true, but as Jim says, there's a lot of bullets that the government has to use, and I came away thinking similarly. China is not going to boom, so the growth question, there's absolutely no way in my mind that China would be growing at 7% in 2 or 3 years. It's going to be much more like 4 or 5%. But I also think it's highly unlikely we're going to have a crash in China in the next couple of years.
Yeah. Well, that I think brings us close to the end of our one hour time period. Thank you all for being here. We particularly appreciate all your questions, and I hope you found it useful. Thank you. Have a good afternoon.